Hello and welcome to Market Domination. I'm Myles Udland, live from our New York City headquarters here at Yahoo Finance. We've got an hour to go until the market close, and the sell-off has intensified through the session. Let's take a look at where things stand at 3 o'clock here. The Dow is off 1,900 points, good for a 4.9% drop. That's the best performer among the three major indexes. The S&P 500 down 5.5%, NASDAQ down 5.4%. We're seeing the NASDAQ 100 tipping into bear market territory. The S&P 500 thinking about flirting with that as well. Joining me to discuss the sell-off and everything going on in markets today and this week, we're joined by Joe Brasuelis. He's the chief economist at RSM, as well as Corey Johnson, Epistrophe Capital Research chief market strategist and the host of the Drill Down podcast. All right, where to begin? We were saying just before we came on, there was a jobs report this morning, which I barely remember at this point.
It's been a day.
It has been a day. It's been a couple of days. Corey, let's just start with the market action overall. What you've thought of the last 2 days, really going back to Wednesday afternoon, because I will admit I kind of came into Trump's announcement and I'm like, he'll say some stuff, it'll probably be fine. And it has felt like Brexit, COVID, a couple different things all tied into one.
Yeah, I think that there was some hope that there was a plan behind this, and the plan might be negotiating tool, lots of threats, then back away. And we've heard some people who know a lot about a lot saying that that's exactly what was going on. Mm-hmm. But what we've seen here is there doesn't seem to be a plan, and the plan seems to be slap tariffs left and right, with the true belief, is just what President Trump told us running for office. He believes the tariffs work. And all the evidence we have from 150 years of economic history is that they don't work, and that they do the opposite of what the intended goal here is. If, in fact, the intended goal is to increase the power of the economy, to increase manufacturing in the United States, I think the market has figured out, wow, this guy really means it. They're just going to they're going to raise inflation, they're going to slow down the economy, they're going to send us running towards a recession, and they don't want to hear from anyone who disagrees with it. And that's where we're at, and I think that's what the market's reflecting right now.
And so, Joe, looking at just the economic impact that we think may come to pass from what we've heard so far, how did you look at it in the initial hours on trying to guesstimate an overall tariff rate or what this would mean for GDP, inflation? Like, how have you looked at what your forecasts and assumptions were and tried to revisit them maybe in the last 2 days?
We thought the effective tariff would end up around 20%. It's 23%. I thought we'd end up with a 12 to 15% average weighted tariff. That's a little under 19%. So in many ways, it landed sort of where we thought it would. But the problem is the execution of it, that nonsensical introduction.
Madagascar?
Yeah, of the formula. These aren't reciprocal tariffs. These are punitive tariffs. And it's the loss of credibility on the part of the administration, the loss of confidence of markets in them, which is what's causing this. They really need to step in and say, hey, we have an off-ramp here. This isn't a leverage negotiating situation. Mm-hmm. Or I love the Dodgers, they bring in the high leverage reliever. They got to get the high leverage reliever off the bench and get it in the game, because we can't go on with.
But here's what's different about Trump 2.0, right? Yeah. Is that there aren't relievers there. There aren't different. There aren't. It does not seem that there are voices in the administration, as there were the first time when Trump was president, voices that can disagree, voices that can say, interesting idea. What about this? Everyone's all in the same boat here, and they're all going the same direction. They're all leaning on the same side, if I can stay on that metaphor.
I have to admit, earlier today, I'm like, where's Gary Cohen? And I remembered, oh, that's right, he's not there. Right, and that's the problem.
Yeah, I was going to say, is it about the agreement or not, or is it just simply the presence of folks like Gary Cohen, like Stephen Mnuchin, who really had the trust of the market? And right now it feels like there's no one in that administration that an investor can look to and say, oh, okay, that guy's on TV, he'll probably call
We're here amongst friends. Well, this is a Wall Street.
Yes, we are.
We are, right?
Just tens of thousands at home as well.
We all know who Howard is. Yeah. He's not the guy, right? What we need is Besson to step up.
You probably know him as long as I've known him.
Yeah, no, we all know Howard. He's not the guy, right? Keep sending Peter Navarro out on television every morning.
He's not the guy.
You're going to get the same outcome. We really need Scott Besson to step up and play a more pronounced role to calm and soothe nerves, or again, this is just going to continue to go on. You know, we were talking just before we started the show. We're not that far from them stopping trading at this point.
That's right.
That's how far down we are.
Well, we don't have, to get to my point, as we talk about this White House, we don't have a team of rivals.
No.
Right? We've got a team of sycophants. We've got a team, but they agree very strongly on the same things. And it does seem that a good part of America believes that whatever the White House tells them and really wants to believe that those things are true. And so and we have for lots of interesting reasons, we have a media echo chamber where they're not hearing the voices that everyone else is hearing. And people are hearing the voices that they want to hear. So they're hearing cheerleading from the media outlets they want to be on, from the places on X that they want to be on, from the, you talk about, this is already surgical decisions here. These are the people who celebrate cutting jobs with chainsaws. And there's no sort of notion that nuance is a good thing.
Right. I mean, it was very clear to me when they introduced the Madagascar equation that they have a very low evaluation of what Wall Street is. And we all figured it out within about an hour.
Right.
And we could tell that this just didn't sum up. Right, and then that's what really set the tone for Thursday into Friday.
Yeah. Well, and speaking of that view on Wall Street, Corey, I want to get your thoughts on what's the level, if there is one, on the S&P or whatever you want to look at, where they may actually cry uncle. Because the biggest change from an investor standpoint in Trump 2.0 is that the stock market is not only the scoreboard, a scorecard as it was used the first time, it is now actively viewed as something to ignore because those guys doing all this that we're looking at on the screen, for whatever reason, are now viewed as the folks who don't understand what we're trying to accomplish.
Look, I think that what's interesting here is, and as I look at my portfolio and I'm looking at the names that I cover as an analyst, and I've done a lot of work in crypto. Right now, that's I'm not suggesting anyone invest in crypto, but I've been saying for the last couple of years that Bitcoin is not in fact a store of value; it is a store of speculation.
That's right.
And so when I look at all of the Nasdaq-y names, the names that I cover in technology, in semiconductor software, data centers, AI, hardware, that those stocks are stores of speculation. I spent the beginning of this week, I don't want to go too deep this rabbit hole, but I spent the beginning of this week at an optical fiber communications conference. And it was as bullish it was a technology conference, it was not a stock conference. But it was as bullish a place as I have been in 20 years. Every company told me they were pushing away orders, they can't get enough money to build their factories fast enough to build this. They're talking about revenues in 3 or 4 years of 400% higher or more. I talked to a CFO of a publicly traded company, told me off the side, says, you'd have to be an idiot not to be in this business and just killing it right now because the orders are coming in the door. Those stocks are down 20% this week. And it's because they are stores of speculation. And so right now the speculation is coming out of the market and all the air is coming out of the market.
And the retaliation put to the United States on China today was what you'd expect, goods and rare earths. When we get to the portion of the play where the European Union starts to retaliate.
Monday?
Yeah, probably Monday, maybe Tuesday at best. It's going to be the banks, it's going to be financial services, it's going to be airlines, it's going to be tech. And I'm telling you right now, market is not priced that in. They fundamentally think this is just a repeat of 2018. So there's a lot more damage that could go on here, which again is why it'd be a good idea if in the next hour somebody came out and said something, rational, so we can at least calm down because someone's going to have to step up.
Who's
I'm not counting on that guy.
Who's the rational?
I think
who's the rational person in that?
I think we named a couple of folks that aren't in the administration right now that I think investors want to hear from.
I think you can put Kevin Hassett over on Fox Business News within the next half hour and calm things down. It wouldn't take much.
Speaking of Kevin Hassett and a job that he may be looking at later this year, amid all this, we did have Fed Chair Jay Powell speaking earlier today, and he took some questions on the economic outlook, and he really did little to reassure investors. Joining us now to discuss is Yahoo Finance's Fed correspondent, Jennifer Schomburger. Jen.
Good afternoon, Myles. That's right. Fed Chair Jay Powell saying today that the central bank is very much in a wait-and-see mode now that bigger than expected tariffs could lead to lower growth and possibly longer-lasting inflation, a change from a view that Fed Chair Powell had a couple weeks ago that inflation from tariffs could prove temporary.
It is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth.
He says that the outlook is highly uncertain and that there are now elevated risks to the downside and that higher inflation as well as employment, but that the economy is still in a solid place. Just ahead of Powell's remarks this morning, President Trump posted on his social media site, quote, "This would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He's always late." He went on to say, "Cut interest rates, Jerome, and stop playing politics." But Powell noted on his own volition that the Fed is well positioned to await clarity before adjusting interest rates.
It feels like we don't need to be in a hurry. It feels like we have time
Really?
to, yes, it feels like we don't. No, I mean, it's like I said, you have inflation's going to be moving up and growth is going to be slowing, but it isn't really, to me, it's not clear at this time what the appropriate path for monetary policy will be. And we're going to need to wait and see how this plays out before we can start to make those adjustments.
Now, Powell says he anticipates higher tariffs could lead to an increase in inflation in the coming quarters. Whether or not that proves longer lasting will hinge on long-term expectations, she tried to say, for inflation, along with the size of effects from tariffs, as well as how long it takes for these tariffs to actually filter through to prices. And Myles, earlier this week, I spoke with New York Fed President John Williams, who told me he thinks it could take a couple of years before these tariffs could filter through fully to prices. Of course, that came before the actual tariff announcement on Wednesday. Back to you.
All right, Yahoo Finance's Jen Schomburger with that report. Joe, I want to get your thoughts on what you made of Powell's speech this morning. And I think what struck the market, because the market hated it, was the focus now on inflation expectations, and really pushing back against the pricing we saw just a day ago for 4 cuts in 25. That doesn't feel realistic at all.
So if you're a central banker and you have pressure on both sides of your mandate and you're put in the corner, which Trump's really put Powell in a corner, you're going to lean towards the price stability. At this point, when you get tariffs, the Fed can look through if it's a one-time effect that doesn't have any other issues, right? Those 2 issues being retaliation, well, you can start checking that box off, and inflation expectations rising. Once you see that, then the Fed really is in a box. Because if they see 5-year forward break-evens begin to move to the upside decisively, above 2.5 towards 3%, it's sitting at about 2.3% right now. They're hiking rates, they're not cutting. I don't know about you guys. Earlier today, the market had priced in 5 cuts, which is their weight out over their skis.
It's funny you say that, because I was reading this speech today and I was like, am I crazy for thinking this sounds like we could be raising rates this year?
No, not at all. I mean, look, what John Williams said is serious as a heart attack. It could take up to 2 years for this to work through the system. And given the level of retaliation, and not just the idea of retaliation, but the breadth, scale of it, we really could have a surge in inflation here. My own forecast tells me 12 months from now, CPI and PCE are going to be floating between 3.5% and 4%, and that's if all goes well.
Let me translate. So what you're saying, or you can tell me how I heard that right. So what you're saying is that some people have had a notion that yes, tariffs will cause inflation, but because inflation by definition is prices go how they compare to the last period, that in the next period they'll be flat.
That's right.
And that's been the belief coming into this, that we target Jack Daniel's whiskey and we target Harley Davidson from Canada. But in reality, we're going to see 24 months of increasing prices because it's going to find its way through the economy and raise prices left and right. And farmers will go out of business, and we'll have all these changes that are driving down production and driving up prices.
Right. If there's no deal with the UK, I've got a speaking gig at the London U.S. Embassy in October. I'm going to be paying an extra 25% to land. No, but seriously, that's one of the issues. That's what's going to happen. That's not in the psyche of the American public, nor is it in the psyche of policymakers, and that's where I think we might see the first rebellion inside the Republican-held Congress to say, wait a second, this is now going too far.
Yeah, eggs is one thing, but now if we're talking about all the inflation, right? Back to the 2022 story, certainly not something those lawmakers want to deal with. All right, we are also following the latest developments on the sale of TikTok. President Trump announcing a short time ago that he will sign an executive order to extend the deadline for TikTok to find a buyer, and that will keep the social media platform up and running for another 75 days. In the post on Truth Social, Trump said the administration has, quote, made tremendous progress on making a deal, but requires more work to get done. In a rare statement, ByteDance, TikTok's parent company, responded to Trump's announcement, saying ByteDance has been in discussion with the U.S. government regarding a potential solution for TikTok US, and an agreement has not been executed. There are key matters to be resolved. Any agreement will be subject to approval under Chinese law. This all comes as a flurry of other possible buyers coming out of the woodwork: AppLovin, Walmart, Amazon. I don't know where to begin with this, Corey. My view on this is, like, this has been going on for 6 years, and of course, within 48 hours of
goes
Trump
down to the
announcing the biggest tariffs that we've seen in 100 years in the U.S., biggest really step change ever
Right.
in terms of tariffs.
Right.
The same country that's really the source of his angst has a massive platform that they're trying to cleave off to the U.S. I don't really know where to begin with where this ends in 75 days.
Let me provide a different lens for thinking about TikTok than the TikTok creators out there, of which I am one. And I'm biased in a couple ways. One is my Drill Down Pod TikTok channel has been super successful, if you can believe it, like going on there, talking about stocks, talking about earnings in 1 minute, 30 seconds.
Huge place.
It's been it's been positive. I've gotten a lot of response there, and people are seeing our research in ways that they wouldn't otherwise. I think of this as a technology analyst as a data story, right? There's a media story, certainly. We see the thing on the top layer, which is what the media is. But there's a huge data story here because unlike Meta, which has its own data centers, unlike Google and YouTube, which have their own data centers, TikTok does not have their own data centers in the US. So whose data centers do they use? Oracle's.
Yep.
So Oracle came to the data center business late. Amazon Web Services was already out there. Microsoft Azure was already out there. Even Google was out there in size. IBM trying to find a way to the market. Oracle decided, Oracle, a stock that I own and a stock that I cover, so I'm fully biased here. And I actually like those people a lot, even with greater bias.
Yeah.
I can sell the stock. I can't get rid of those friendships. But Oracle came to the this data center business late, and they needed a big tenant. And they needed a tenant to push out the architecture that they imagined would be very successful for other companies, but they need a lot of money to do that. So TikTok US was the engine of Oracle data center growth. And so when you see Oracle emerge as a name here, and you see Amazon emerge as a name here, it's not because Amazon wants to sell stuff on TikTok, sure they do. But they want to take that data business away from their competitor Oracle. It's telling the world Amazon Web Services sees Oracle as a real competitor right now. And Oracle knows this too, so Oracle wants to be part of a deal. And so what I expect, and Safra Catz, the wonderful CEO of Oracle, was part of the Trump transition team in 2016. I was in the atrium of Trump Tower in 2016 during the transition. And I was with a bunch of people, a bunch of reporters there and cameras there. And I look and I see Safra Catz walking in, and she walks over to me. Hi, Corey, what are you doing here? I'm like, what are you doing here? Yeah. Well, she was going up for a meeting.
And Larry Ellison, of course.
Larry was not in that meeting. There was a meeting.
Not in that meeting, but
Right.
he's in the orbit, yeah.
So Larry's super close with President Trump, big supporter of a lot of Republican policies. So is Safra Catz, strong supporter of Israel, strong supporter of President Trump. And so I think that Oracle's got a seat at the table, and they need a seat at the table.
And you think a deal's going to get done?
A deal's going to get done. What I expect, is my guess, I'm guessing, but is that ByteDance is not going to let the algorithm out, but they might lease it. Yep. And so they lease the algorithm. There's some media buyers. I don't know if it'll be AppLovin. That'd be interesting. It's an interesting company.
Right. Yep.
But there'll be some media buyers. There'll be somebody rando, and Oracle will be there as part of the deal, making sure the database center business stays in the Oracle data center.
All right, 75 more days. I guess we'll find out if that all works out. We keep TikTok here. All right, a lot more coming up here on Market Domination. We're going to go live to the floor of the New York Stock Exchange for an update on this intensifying sell-off right after this. All right, stocks deeply in the red here, about 40 minutes to go in the trading session. Let's go to Yahoo Finance. Jared Blickery standing by live on the floor of the New York Stock Exchange. Jared.
Thank you, Myles. Let's go to the Wi-Fi Interactive. I'm looking at a Dow approaching down 2,000 points. If I put the 2-day up there, you can see it's down 8.61%. S&P 500 down almost 10%, and the Russell 2000, the small caps, the worst of the bunch, down about 11.43%. I'm going to be doing a deep dive with you in an hour on how this looks like some of the earlier days of the pandemic. But for now, I just want to spotlight volatility. We got the VIX here up to 44.32. And if I put a one-year chart on, you can see this would be the highest close if we were to close at these levels in that time period, even exceeding the Yen-Mageddon close from last August, although intraday it did go a little bit higher. We just had the bond market close at 3 p.m., so we can get a read on that as well. I'll punch up a year-to-date. The MOVE index, so the bond market volatility, has been heading higher here towards the highest levels that we saw in March, so not quite as great as stock market volatility. But then take a look at at the 10-year T-note yield. I got to punch up a 1-year chart to go all the way back. We're at the lowest level since October. And take a look at this. That's, you don't even have to squint. That is a head and shoulders top right there. And a measured move points to a trip all the way down to at least 3.5%. So could be looking at some big psychological numbers, even though we're at one right now, which is 4%. So 3.5% in the cards technically. US dollar index rebounding a little bit from yesterday. I'll show you the 2-day chart. US dollar is going in the opposite direction. That has not been the case over the last few days. Rates and the dollar have been going hand in hand. And let me just punch up Bitcoin as well, because that's really interesting. Crypto up 2%. Is it an inflation hedge? Is it a Trump hedge? Well, whatever it is, it's doing its job today, holding on to some value. I'm going to look at some heat maps now, and we'll start with the sector action looking pretty bad. Energy, which had been the worst of the year, or excuse me, best of the year, is now the worst today. It's down 8%. The best off is consumer discretionary, which is only down 3%. And you look at the 2-day totals, pretty impressive to the downside. Energy down 15%, tech down 12%. So a little visual representation of the carnage that we're seeing right now in the markets.
All right, Jared, we'll get a check with you once the dust settles and see just how ugly those numbers are. Jared Blicker, live on the floor of the New York Stock Exchange. All right, well, the auto industry has been at the center of Trump's tariff discussions for years, and this week's developments have created further challenges and uncertainties. Joining us now to discuss is Edison Yu, U.S. autos analyst at Deutsche Bank. Edison, let's just start with how you and your team have tried to understand this week's news, its impact on your coverage, and let's just start kind of with the big three there, Ford, GM, and then, of course, Tesla.
Yeah. So I think there's kind of two elements to this. One is you have prices that are going to go up. And how do you deal with that? And there's really no short-term solutions. I think you've probably heard many people say the supply chain is very interconnected. And I think that's a really structural issue that the automakers will have to figure out. The second element which is much, much longer term, is what does auto production in the US look like? Is it going to be more akin to something like China, where 90%, 95% of the parts are sourced domestically? Is it going to be lots and lots of robots and automation? We don't really know. And those are kind of 5-10-year decisions. So there's just a tremendous amount of uncertainty, both in the near term, midterm, and long term. And trying to put numbers around that is very, very difficult.
All right, two-part question for you, Edison. First, are we going to end up with taxes on parts going back and forth across the border at the end of the day? Second, a little bit of a bigger question. NAFTA, or the USMC, is really about two ecosystems. One's autos, the other's food. Are we going to end up with two separate trade agreements, one with Mexico, one with Canada, having differing rules? And how would you go about viewing that?
Yeah. So the reality is no one knows. And I wish I could offer you some deep insight that I've had with discussion with the administration. It's simply no one knows. We've talked to multiple suppliers, we've talked to multiple OEMs, and all this is being discussed behind the scenes and trying to be hashed out, but no one really knows. If I were to guess, I do think there will be some type of exemption carve out for NAFTA or USMCA, and if that happens, obviously the D3. GM, Ford, and even Stellantis would benefit that relative to the Asian and European OEMs, but we really don't know. I think more generally, in terms of having multiple kind of like spheres or systems, it's really a structural question. And I think it goes far, far actually beyond autos. It's really about localizing multiple supply chains in the US, and auto is just kind of a poster child for it because it showcases kind of how vulnerable it is if you leave the country. So I think both great questions. Unfortunately, we can only offer kind of guesses into what will happen, but those
all there,
are preliminary thinking.
Edison, Corey Johnson here. Since Joe with a two-part question, let me give you the same. And I'm curious about what this means for the used car market. And I wonder if there's going to bifurcation. So what does this mean for the used car market, number one? But number two, is there a bifurcation in the used car market where the vehicles that are facing higher tariffs and higher increases in the new cars will pass over to the used cars? Will my used Porsche garner a much higher price than a used Ford or something?
Yes. So prices are going up. We've done a tremendous amount of math around some scenarios. I mean, you're probably looking at anywhere from 5% to even 15%. Now, will the consumer absorb all that hit? Probably not, right? As an OEM, you're probably going to absorb some of it. Dealers have pretty decent margins. They may take some of the hit. So what is the net impact, the net margin, net price increase? It's a bit tricky to say, but I think you're looking at something at least 5%. And so if new car prices go up,
domestic vehicles.
Yes.
But I'm saying, like,
yes.
is a used German car, purely German car or whatever, that is going to face the highest tariffs, are those used vehicles going to also increase at a double-digit rate?
Yeah. I think, if you look at historically, right, new car prices go up. I think it will drag up, especially in this case, used car prices. I don't know if it will happen all in sequential order, right? Because you're going to see a big surge in demand, right, for the next month or so. And you've seen Ford, GM, Stellantis, some of these automakers come out with some discounts. So I don't know if your Porsche is going to go up immediately that much, but I think over time it will absolutely appreciate.
Porsche buyers DM me now. Sorry, but
I was just
asking for a friend.
We'll check back in a few months, see how Corey did with that. Edison, last one I want to chat here on an Elon Musk specific question around the Tesla story, and news out earlier this week that Musk is looking at kind of paring back his responsibilities with the government, focusing maybe a little more on Tesla. I'm curious how your team thought about that part of the story over the last few months. Certainly there's the demand side, the fundamental side for Tesla, but stock was down 50%, and it took a while till we started to see Musk, he had that all hands, whatever that was 2 weeks ago. I'm just curious how you think about his leadership, his role, where that story is at right now.
Yeah, I think it's a double-edged sword, right? You mentioned stock is obviously down a lot. You also have to keep in mind how much it went up after Trump won, right? So it's a double-edged sword. It can work for you, tremendously work against you. I think right now there's other issues to deal with, right? The volume you may have seen has been quite weak. It seems to be turning around, at least in some parts of the world. They got some new models coming, including what we call the Model Q. So there's a lot of elements here. And I think the politics is certainly an overhang, but it's not the only driver of some of the stock weakness. You also got a robo-taxi day coming up in June, or a robo-taxi launch coming up in June. So the Tesla mosaic, I wish I could just point to the politics and blame it on that, but I think there's actually multiple drivers for the weakness recently in the stock. And let's say the politics kind of, settles down a little bit, you still got to deliver on, 2-3 other things.
All right, we'll leave it there. Really appreciate the time. Edison Yu, U.S. Autos Analyst with Deutsche Bank.
Thank you.
All right, now it's time for some of today's trending tickers. Let's start with shares of Berkshire Hathaway. Stock down about 7% today, but it's been a name that has really outperformed the market here. It was up about 13% in the first quarter, while the S&P was down about 10% over that time. Now, in February, Warren Buffett revealed in his annual letter to shareholders that the company's cash pile had ballooned to over $300 billion. He didn't exactly say he was worried about the market, but his actions certainly spoke louder than his words in that situation. Buffett has famously said, of course, be greedy when others are fearful. A lot of fear out there today. We were just looking at the stock chart before. I think there was a sense maybe, and maybe I'm just imputing this on people where it didn't exist, but Buffett's sitting on cash. Market went up 20% 2 years in a row. What's this guy doing? Has he lost his fastball? And here we are 3 weeks later, and it's like, I guess he's still got it.
How long have we been hearing that conversation?
Yeah, forever.
I'm biased here too because I'm a longtime Berkshire shareholder, and I do think that in market moments like this, the typical Berkshire buyer holder becomes a Berkshire buyer, and they sit around for years just waiting for the day they can buy some. They wait for a market down 20% and they buy it. They've got a rule, and I think that you see that happen across the market.
And
we've seen it for years.
And it's very clear we still have another leg down on this market, and Buffett's going to move in. I'm seeing talk about people who are thinking, 3-5 rate cuts, maybe we'll go into housing stocks. They were up today, right? Yep. Mm-hmm. But you take a look at Berkshire Hathaway and you think, I can remember what he did. The way he stepped up and stepped in 2008, we were all there, and he's going to do it again here pretty quick, and those investors will look prescient.
Remember all those great convert deals he did?
Oh yeah,
like
completely.
the
Bank America one, the Goldman Sachs.
The Goldman one's the one I really focus on to this day.
At the time, I was working at a short-only fund, one of the biggest in the world. And every day you'd see something on the tape that you couldn't believe, like Lehman going under, right? You'd see just things that were just amazing. But those were like, wait, he's getting what deal?
The warrants, remember the warrants he got?
Yeah.
And immediately
In Bank of America.
everybody started criticizing the government and
Right.
the warrants they didn't get from Fannie and Freddie and other places.
Ended up what? I think biggest shareholder. of
I'll
Bank
just
of
lob one in
America.
real quick. I do think that we've heard some things from President Trump about TikTok saying the government wants a piece of this deal.
Yeah.
And that could be one of the things holding it up, because the notion that the government getting criticized for not being a part of the deals, if the government's ever done that, doesn't really do that, unlike, say, Singapore or something where they've got sovereign wealth funds that are constantly making deals. That could be an issue with TikTok as well. I do not expect Warren Buffett, however, to emerge in the TikTok bidding.
No.
But if he
Not
does,
his
if
cup
he
of tea.
does, if he does. All right, next up, let's take a look at two stocks. They've gotten hit hard by tariffs, but I think the real story here is they're basically trading at 10-year lows, and they are big consumer names that you know, and that is Nike and Disney. Let's start with Nike. Now, this stock is actually up about 6% today. We had President Trump saying that Vietnam, where the footwear giant has a large manufacturing presence, was willing to eliminate tariffs to avoid some new U.S. levies. So there's the beginning of some kind of negotiation. Jared was talking earlier about consumer discretionary being the worst performer on the day. Nike certainly helping there. But let's also take a look at Disney. That stock is down over 5% today, one of several media companies that's gotten hit. Trump tariffs won't directly impose new costs on Hollywood, but analysts say, of course, rising costs and potential recession would lead to consumers cutting discretionary spending, media entertainment, and it's going to prompt marketers perhaps to scale back advertising budgets. Also here you have Disney, the best of its media peers, maybe re-rating towards some of those other names. And I just looked at these two stories, and we have the Nike news today, but you go out on the street, you say to someone, oh, Nike, Disney, those must be great companies. And I think that what's so interesting in these market moments is they're trading at 2015 levels. Like, this is a broken story for a longtime shareholder, and perhaps maybe it's not underappreciated. To me, it's underappreciated in the market. This is a bad situation.
Those are very good firms that you're probably going to be able to acquire at a cheaper price in a number of days. Look, the minimum 10% tariff that I don't think is going away is a $410 billion tax hike essentially on consumption. A very inelegant consumption tax, but nevertheless, that's going to hit somebody who owns entertainment centers like Disney. Now, Nike's lumped in with a number of different firms that moved out of China to Vietnam during Trump 1, and they're getting hit now. I actually think that's why the president was out today, because he's trying in his own way to sort of pave the way towards a potential off-ramp. But I do feel bad, and it's not just for that company, companies like Lululemon that are sitting there just getting shellacked because they're in Vietnam.
Yeah, I also think that different companies, as it relates to Disney, right? So maybe one of the best CEOs, I think, in all of business, in Bob Iger for now. But when you think about the consumer of the parks in particular, or the place this is going to hit the U.S. consumer, the rising inflation is going to hit them, is in discretionary spending first. Right? It's the first thing to go. Yeah. So going to Disneyland or Disney World, I used to do that when my kids were little, and these are expensive trips. Those things are going to pull back, guaranteed. Right, that's going to really hurt Disney. Yeah. You've also got the effects on Disney in Europe, Disney in China. Yeah. So Disney parks are in a rough situation here. Probably so is the notion that consumers who are subscribing to a service besides Netflix will be subscribing to ESPN, Disney, Hulu.
I mean, look, within 2 quarters, personal disposable income is going to go negative because of the consumption tax that's been put on the American public. I mean, there's a lot of other companies that are going to get ensnared in this, and that's just the unfortunate situation. And that doesn't even include retaliation or the punitive trade taxes that Trump's put on the other 60 countries. Yep. So we'll have to see how this all pans out, but it's not going to be good for discretionary spending going forward.
A couple easy, clean ways to see, how investors think that might play out in the early going. All right, coming up, we're going to talk about oil futures, which are trading at a roughly 4-year low. We'll speak to an expert on the other side of this break. Stick around, more market domination still to come. All right, let's take a look at oil prices. We had WTI down about 6% today. Brent crude prices off about 5%. number of different problems here for the oil market. Trump's tariff plans, China's retaliatory tariffs, and then yesterday's production announcement from OPEC Plus. All of that adding up to a tough situation here in the oil markets. Joining us now to discuss is Goldman Sachs' co-head of global commodities research and head of oil research, Don Stuyven. Don, thanks so much for stopping by. Let's just start with your team's forecast, which you revised yesterday, what you're expecting now to see in terms of pricing in the market this year and out into the future.
Yeah, thanks a lot for having me. So we did downgrade our oil price forecast by $5 per barrel yesterday because the two downside risks to prices that we have been flagging are realizing. Both a weaker demand outlook on the back of tariff escalation, and then on the supply side, somewhat higher supply from OPEC. And so we now expect Brent prices this year in the mid to high 60s, pretty close to current levels. TI this year in the low 60s. And then actually for next year, we look for some additional declines with Brent in the low 60s and TI in the high 50s. And the risk to this reduced price forecast are still skewed to the downside because recession risk is elevated.
So if this is primarily driven by decisions in Washington, D.C. and the White House, what levers does the White House have, particularly the strategic petroleum preserve and filling that up, or where do we stand with that? Can that move this needle at all?
The White House does influence oil prices to various channels. I would point to, on the demand side, the impact on the economic outlook via tariffs or policies that may be positive or negative for the outlook. On the supply side, we do think that the White House does influence the level of inventories via strategic reserve strategic reserve purchases.
I couldn't say it either. We're good. You're in good company.
SPR purchases, yes. But that tends to be a fairly slow process to refill. And it doesn't tend to boost prices quickly when it happens. However, when prices rise to extremely elevated levels, the release of barrels, which tends to soften prices, tends to be more impactful and quick. But the speed is asymmetric. And so in our view, the key channel here really through which U.S. economic policy is influencing the oil price outlook is primarily through the demand side.
Dan Jobrasuelis here. A lot of us have been surprised by the steady increase in supply over the last 3 years or so. Is this just a natural function of where we're at in the cycle, or is there something going on intra-industry that has to do with elevated levels of productivity?
Yes, so if you look back at the last 3 years or even the last 10 years, the U.S. Has been driving about 100% of the increases in total liquids supply. Despite relatively disciplined investment policies. And so it's, to your point, it's really a combination of really terrific productivity and efficiency gains, I think accelerated by consolidation, companies sharing and exchanging and implementing best practices more broadly. And then also, the US is now producing a lot of natural gas liquids. So black oil, crude oil supply is growing at a slower pace, and we think it's going to slow down further on the back of lower prices. But natural gas liquids continue to surprise oil analysts and continue to provide a lot of liquid supply to the global oil market, where we think spare capacity is quite high. And high spare capacity is one of the key reasons we think why OPEC has decided to raise production more, on top of the desire to improve compliance with cuts within the group, and the desire to strategically discipline production outside of OPEC, in particular in the U.S. shale complex.
Don, I want to get a perfect segue to a quick question I want to get. We're almost out of time, but I do want to ask you about the U.S. shale complex, about the Permian, and what is you've predicted essentially a $64 deck. What does a $64 deck mean to the Permian?
So we are starting to approach price levels that are becoming close to break-even levels.
That's not good.
For the higher cost producers. And so we think shale supply is slowing down. We think the average break-even price in the Permian is around $50 per barrel TI. But some of the more expensive high-cost producers are facing current prices. And so that's why we think U.S. shale supply growth will slow significantly.
All right, Goldman Sachs' Don Stuyven, thanks so much for stopping by, talking about the oil markets.
Thank you.
All right, well, housing got a bit of a reprieve from Trump's sweeping new tariff agenda. Looking here at some of the best performers that we can find in the market today. TR Horton, Lennar, those stocks up among others. Several key building materials are exempt from facing further tariffs at this point in time. But markets under pressure, worries about the global economy. How's the housing outlook shaping up as we move into the teeth of the spring selling season? Joining us now to discuss is Jim Tobin, CEO of the National Association of Home Builders. So Jim, let's just start with what you and your members have been talking about through the kind of the whole tariff discussion, where we're at, rates, the whole situation on how you stand as we enter, I guess, a brand new era for U.S. trade policy.
Yeah, a lot of uncertainty in trade policy. You know, in 2023, we used over $200 billion in building materials in this country. And about 7% of that came from over our own borders. So trade policy is critically important. China, Canada, Mexico, in that order, are our largest building material trade partners. And plus, a lot of materials come from many other countries. So we are watching the tariff situation very carefully, working with the White House, talking to the White House about the uncertainty that we've created, not only in the macro economy, but also in the building materials sector, which are critically important to building affordable housing in this country.
All right, so I think that we're short about 3 million homes relative to demand and demographic change in the United States economy right now. Give me your quick elevator pitch on how we would fix that.
Build, baby, build. It's pretty simple. The only way we are going to create a more housing affordability in this country is to build more housing. We've underbuilt since the Great Recession. This year, we're going to underbuild again. We're predicting about 1 million single-family units this year, 200 to 300 multifamily units this year. We need to build about 1.5 to 1.6 million units. That's both single and multifamily, not only to meet household formation, immigration, and replacing older housing stock, the traditional drivers of building demand in this country. But then we've got to talk about that backlog that you cited. And the only way to do that is to get up to that trend line of 1.5 to 1.6 million units. That's the only way we're going to do that. We need all levels of government to jump on board. We need to make sure that we can keep building material prices low. We need to extend the Trump tax cuts, and we need a deregulatory environment that is really going to help reduce the regulatory burden on home creation in this country.
So many questions. How about a science question? I want to talk about lumber. I think that there's a misunderstanding that we can replace Canadian lumber with trees and lumber that comes from the U.S. Can you talk to us about why Canadian lumber is particularly necessary for home construction in the U.S. and why it's different than U.S. lumber?
Sure. We don't produce enough lumber in the United States to meet demand. We get about 30% of our lumber supply from over our shores, and the bulk of it, about 70% of that 30%, comes from Canada. The species of wood that comes from Canada specifically from their northwest provinces, that is a preferred building material for studs and framing. It is different than southern yellow pine, which is the predominant southeastern species of pine trees that we use. Now, we also have that particular Canadian species of lumber in our Pacific Northwest. But since the late 1990s, we have no longer cut and harvested timber off our national forest. In fact, in the late 1990s, we were pulling about 12 to 14 billion board feet off our national forest. Since then, we've treated our national forests like national parks. We've really slowed down timber production of our own domestic renewable resource on our Forest Service lands. Last year, we cut about 2 billion board feet. Guess where that delta of 10 billion board feet now comes from? Primarily Canada. So while there is a preference for Canadian lumber, it's really a supply and demand issue. Until we cut enough and mill enough in the United States, we have to look over our own borders to meet demand for lumber in this country.
And Jim, last question for you. I want to talk about the immigration situation and the labor constraints that we've also seen in the housing market over the last years now. But sort of what's that dynamic been like this year with some of the administration's new policies, and how your members are thinking about that constraint as well. With this potential, with this built-in demand backlog, as Joe was talking about.
Yeah, the construction industry continues to have a persistent labor shortage, about 200 to 300,000 jobs every month for the better part of a decade. We're just not bringing the next generation of men and women to work in the trades and train them in this country, whether it's starting in grammar school and high schools and moving through the trade schools after high school. So again, we've got to look at immigrant labor. About a third of the trades is immigrant labor right now. So when you talk about an immigration policy that is very constrictive, it is going to hurt our industry particularly hard. So we are watching that very closely as well. Of course, we believe in securing our borders and providing a pathway for people to come into this country to work in the construction industry. But right now, there is a lot of confusion in not only the enforcement policy, but how are we going to bring people in? And that's only going to add to the cost of housing right now as well.
All right, Jim Tobin, CEO of the NAHB. Thanks for the time. All right, well, big bank stocks have been taking a hit amid these tariff woes and concerns over the potential global impacts. This coming just a few days before big banks are set to report their first quarter earnings results. Yahoo Finance's David Hollerith joins us now to talk more about all of that. David, let's just start with what we've seen from the majors in the last few days. Again, we're 1 week out from hearing from what I guess it could be JP, Bank of America, a few others on Friday.
Right, yeah. This week, it hasn't closed quite yet, but we're looking at about a 12% to 16% drop for all the big banks across the board.
You say wow?
Say wow.
Yeah.
Wow.
That's a technical term.
Well, you say wow until this
right.
week,
Yeah,
and
yeah.
it's kind of a par for the
I don't know if I
course.
can
at this
spell
point.
that this week.
And so the results we're actually looking at that begin Friday when JP Morgan, Wells Fargo, and Morgan Stanley report aren't actually expected to look that bad. If you just go a little bit wider to the banking industry in general, KBW actually has about a 3% rise in bank earnings year over year, which is not bad. And so really the issue and all the focus for earnings is going to be around guidance and what bank executives are going to say. And that's going to be particularly tough because at this point, no one really knows, what they can guide to. But what we're hoping for is whether or not they can hold on to their guidance for their net interest income, which is where the bulk of their revenue comes from.
And we saw some news today. I think we've got, Corey, 4 or 5 different companies have pulled their IPOs. That's been another kind of area that investors were excited about when it came to the banks. And I'm just curious, how you think about that as a signal, more broadly for investor sentiment, problem for the banks specifically. And we're kind of doing this to a third straight year. IPO window will open, and it feels like it just keeps getting pushed out.
And a big driver sometimes of bank earnings, right, is with those investment banking fees, and not this year, and certainly not this last quarter. When the market wants more stocks, it gets some IPOs, and most of them are crappy, and some of them are really good. Yeah. I can say crappy.
You can say crappy. Okay, yeah, you just did. So
I just did twice. You said it once, so if anyone's keeping score at home, for those of you scoring at home or those of you alone. So I think that where I am in Silicon Valley, IPOs matter a lot. I always thought that New Yorkers pay way too much attention to IPOs, but we don't pay enough attention in California. And IPOs really are the lifeblood of a certain part of our economy out there because it helps take startups into wealthy people, and it helps drive certain portions of the housing market, and it really changes the environment around Silicon Valley. And when IPOs are thriving, startups are thriving. When startups are thriving, startups are spending, and all of a sudden the whole economy of Northern California changes a lot. A stock that I am short, Triple Point Ventures, it's again personal bias out there. I want to let you know that I'm personally short, but I've been following this company for a while. Is a sort of like you can look at it as a proxy for a publicly traded venture capital firm. It's a firm that lends money to venture-backed startups, and this company needs a healthy IPO world in order for it to do well. As you can see from the stock price, it's been cut in half in the last year and a half, and it's not getting the IPO market that it would like to have. It's not getting the IPO market that Sand Hill Road and all the big VCs would like to have, and it really does change the environment of spending of both those companies and those VCs in Sand Hill Road.
And it's interesting.
And the used Porsche market.
Yeah, and I want to run because we got the market close coming up. On a day like today, when the public markets are moving this dramatically, you forget how dynamic that situation is in private markets. And we could do 2 hours on that, more than that, on that dynamic that is going to, you do regularly, that kind of enters into this whole picture here. So, David Hollerith, thanks so much for stopping by. Let's get out of here and get back for the close. Look at all 3 majors now down 5% as we head towards the final closing bell of the week. We'll be back with a lot more on all of that right after this. All right, 5 minutes away from the closing bell here to cap this momentous week. Taking a look at all 3 major indexes. They are all off more than 5% as we head towards the bell. I am still here with Joe Basuelos and Corey Johnson. Joining us now for the conversation as we head into the closing bells, Michael Reynolds, VP of Investment Strategy at Glenmead. Michael, I want to get you in here just on how you guys have tried to think through what we've seen over the last 48 hours in markets, what you've talked about internally with clients, and how you're trying to get your head around what's getting close to a 10% drop here in the S&P in just 2 sessions.
Well, we knew we were heading for some volatility here when Liberation Day, so to speak, came around. And the expectation was perhaps we'd get a little bit more certainty on trade policy. To some extent, we actually did. But when one question was answered, it seemed to spring up 2 more. The biggest of that is, well, okay, we've got the details on what reciprocal tariffs mean now. But what does that mean from here? I mean, countries, some of our trade partners can take one of 2 paths. They can either bring their rates down and maybe we soften the impact of these tariffs, or maybe they ratchet things higher by putting in tariffs of their own. And so we have so many different questions of where things could be going here. The uncertainty is really here to stay for the near term. So it really doesn't surprise us to see a lot of this volatility when you have really a regime shifting change to global trade, when globalization has become such a big theme over the past 2 decades. Upending that is really having some implication for risk assets.
I don't know if it's Liberation Day or Obliteration Day. It seems like the latter. I mean, I'm just going to go with it is the latter. We can see what's happened in the market here in these last few obliteration days. Am I right to focus on, when I'm looking for companies that are going to feel the most pain, am I right to focus on companies that are producing in, I'm looking at the 10K of a company that I'm short I was, since I already mentioned one of my charts, I won't mention this one, but 91% of our revenues in fiscal 2024 are from Malaysia, Mexico, Vietnam, China, Indonesia, and Taiwan. That's not good.
So we think there's 2 ways to look at this. You can look at the direct impact and you can go down that thought process where you look at the companies that are exposed to foreign trade, and really there's nowhere to hide anymore because there's 10% universal tariffs and maybe higher for your Vietnams, your Southeast Asia. But the other part of this is if other countries are going to retaliate, maybe they're going to go after the US cash cows, which is like I would call big tech, Mag 7, whatever you want to call it. That's really a big driver of our economy. And if we're going after big drivers of their economy, that's sort of what's vulnerable on the US side. So we're thinking through both indirect impacts as well as the direct impacts, and it's really quite a lot all at once. So it's, again, not surprising to see a lot of this volatility to the extent we have.
All right, this is probably impossible to do, but give us a couple names that are being unduly punished so we can sort of finish maybe on an encouraging note today.
Sure. I don't know about specific names, but we're looking at small cap in particular, which has gotten hit really hard in this environment. We sort of liked small caps on some interesting valuations to start the year. And if you like them then, you're certainly going to love them in a bear market here. But what we've got to watch closely here is where the earnings are going to go. Because if things get cheap on earnings that just haven't been adjusted for what the tariffs could do here, maybe you're catching a falling knife, so to speak.
And
we're starting to think about that a little bit.
And the reasons I like small cap for the uninitiated out in the audience is they don't have the exposure to the external sector on tariffs on imported goods for the most part, right?
For the most part, yeah. I mean, they're more domestically focused. A smaller portion of their revenues relative to larger cap companies are exposed to foreign trade. There is some argument to be made that larger companies perhaps are a little bit more dynamic in resourcing their supply chains. And we think there's some truth to that. But at what point does the sell-off get too much? We're starting to have those conversations. And really, we're looking at the things that are down the most. And small caps are fitting that bill.
You know, Michael, I'm curious, we got a minute here to the bell, and I want to be quick, but just were portfolios, in your view, positioned to take advantage of these sell-offs? I mean, how are you guys thinking about the mix coming into a year like 25, particularly coming off 2 straight years where the S&P was up 20%?
Well, we'd been making the case for diversification really hard at the beginning of this year, and that was both between asset classes as well as within. So if you had a more diversified approach in your, say, large cap bucket, you were probably avoiding some of the stocks that are down the most this year. In addition, if you had some international equities in your portfolio, I mean, they're down quite a bit today, but actually year to date doing considerably better. So it sort of depends the approach you took coming into the year. If you were diversified, you had some bonds in your portfolio, this doesn't feel great, but you're certainly doing a bit better than some of the stark numbers you're seeing on the screen today.